We went from Thursday, which had a really big intraday reversal. We talked about that it was what's called a bearish engulfing. You start out high and then there's selling pressure all through the day, and that causes you to kind of engulf the other trading ranges in recent days. That continued on Friday with the weaker than expected jobs data. Of course, the market is rebounding a little bit this morning on this idea that, hey, if jobs data is so weak, we're going to get Fed cuts. At the end of the day, we hold that in the very short term, bad news can be good news because it can shift around what expectations are for the Fed and the pricing of yields and the expectations for support. But for risk assets need higher growth expectations. They need the economy to hold up, because the Fed itself can't offset a weak economy. At the end of the day, you do need the growth backdrop to hold up. Now, when we talk about support levels for the market, we're first looking at this February high, which would be a really important support. It lines up kind of perfectly with the 50-day moving average. It's around 61.50 or so. That is a very reasonable level to find support for the market. If that doesn't hold, then you're talking about the 200-day, 100-day moving averages, which could be in play.